Hey, hello, everybody. Welcome to our March forum, where we'll be delving into agricultural insurance. First up, we'll have Minerva, represented by Sandra Marshall. So Sandra is an agronomist. She started off with a career with Agritechs. She was there for 6 years before going to Webby, where she worked with the lead for 5 years, and then into the tobacco industry with Tianze Tobacco for 5 years before joining and it's been with Minerva ever since. Sandra, would you like to come up and run us through what Minerva does? Thank you. We're going to have to hook you up with if you can start. So Tony, what's such a general she pressed the button.
You can give me a signal.
Good afternoon, everybody. As you have heard from Michael, my name is Sandra, and I'm going to present, in fact, I'm going to co-present today with our partner from AFC. So my presentation is just introductory part. Then we are going to delve much on the exact products for the small scale from our partner AFC. So the topic we are going to present, both of us, is on the role of insurance in enhancing food security on smallholder farmers. But briefly start on introducing Minerva for the sake of those who don't know who Minerva is. Minerva has been in existence in Zimbabwe since 1947, and it went through several milestones. Amongst them was changing of names from Aeon to Minerva today. Then, as Minerva, we were still a correspondent office of Aeon. And we are a composite broker in Zimbabwe. By composite broker, we mean it comprises of short-term retail, which is retail where I come from, which is Minerva Risk Solutions. And it does short-term insurance, your motor, your buildings, etc. Then we have Minerva Benefits Consulting, which has got also a division of actuarial consulting. It deals with the employee benefits. Then we have got the reinsurance division, which deals with the reinsurance. That is the go between the insurers and the reinsurers. Then, as Minerva, we are the leading insurance broker with 18% market share. And why choose Minerva? It's a repetition of what I've said. As Minerva, we have an advantage of being connected to several Aeon offices. So we have got a pool of resources we can bank on in terms of innovation, new products, and so forth and so forth. And also on our Minerva benefits, they deal with retirement solutions and pensions for the companies. Then the reinsurance side, they also deal with the reinsurance market, which is outside Zimbabwe. So we have access to products that are even not here locally, and our reinsurance arm will help us on that. Then as Minerva, we are involved in agriculture insurance. That's where myself, I specialize in. Apart from agriculture, like I've mentioned before, we do motor, buildings, all sorts of engineering insurance. So today we are only going to delve on agriculture insurance, specifically for small scale farmers. Then on insurance, apart from crop insurance, we also do livestock insurance. So it's the agriculture by as broad as it is, we have products that covers all the facets of agriculture. Then what value do we bring to growers or to our clients as Minerva? We come up or we draw bespoke products, insurance products for farmers. And we also have expertise in placing how to place the risk. You know, some like agriculture, specifically agriculture, it's a risky. It's more risky as compared to other classes of insurance. So to have placement of it, it's a bit taxing. So we use our expertise from the retail side and the reinsurance side to try and place. Doesn't matter the size of the risk. We are able to place it. We also explain to the clients or simplifying the fine print, the policy wording. You know, there's a perception out there that insurers sort is. So we try and demystify that by explaining the do's, the terms and conditions, the do's and don'ts of the products. Then we also does claims advocates. I think insurance, where there is a catch, is actually on the claims processing. So we do claims advocates on behalf of clients, which are farmers. We also does claims workshop, in education, insurance education workshops to educate farmers what insurance is, what entails, what they're expected to observe, what they're expected not to do in as far as insurance is concerned. And we also conduct claims workshops for our clientele as well. Then we also do, as you have heard, I'm an agronomist, so most of my time will be in the farms. So we assist in crop monitoring, where we can give technical advice. That's where I come in. Then insurance, it's not observed, or we are not supposed to use it in isolation. There is what we call risk management, and the risk management processes entails a lot of processes that one should observe. And insurance, it's actually the talent part of the whole process of risk management. So by the steps are shown in that cycle. The step one is for the farmer. I'm just going to focus on the farmer, identifying loss exposures. As a farmer, you sit down and find out what risks my business is exposed to. There are so many of them. Some are man-made, some are natural, but insurance only deals with those aspects that are not man-made, like we call them the acts of God. So as a farmer, you plant your wheat, your maize, or whatever your crop. Then after you have done all what you are supposed to do, practicing good agronomic practices, that is applying the right fertilizers, following maybe soil analysis results, recommendations. Then you apply the fertilizers as they are required. Then you apply all the herbicides to control your weeds as required. Then you also scout for pests and diseases. Those are some of the activities as a farmer, the farmer can be able to control, then and able to manage. Then you apply all the insecticides and so forth and so on. But after you have done everything, still there are other aspects, or there are other things that farmer cannot be able to control. For example, your crop is good, is weed-free, is pest-free, the yield is looking very, very, the potential is going to, maybe it's a tobacco, potentially going to get a 3-ton, 4-ton crop, but hail comes or windstorm comes, and there's nothing the farmer can do with that. So those are the kind of risks that we cover. So after you have identified as a farmer that, yes, I can do with the fertilization of crop, weeding, and so forth and so on, but I cannot do anything regarding hailstorm, windstorm, flooding. So these are the risks. After you have identified them, you analyze, are you able to control or are you able to absorb the loss if it happens? Then you say, no, I'm not, if my crop is struck by hailstorm, I'll be grounded. And there's nothing I can do about it. Then you have analyzed the exposure that you have. Then after that, you examine the feasibility of the risk management techniques. I think I've already touched on that. You have said, okay, in as far as my processes at the farm are concerned, operations and process, everything, there's nothing that I can do to a hailstorm. Then after you have that, then you select the appropriate risk management technique. You have identified that there's nothing that I can do to a hailstorm. The only solution is for me to look for insurance. That's then when you can then come to us. Then we craft the product. We quote you and we craft the rightful product for you. Then that's implementation part now. When you've taken your insurance, it means you have implemented the appropriate risk management that you have chosen. Then monitoring results, revising the risk management program, and so forth and so on. Then as the crop grows during the course of the season, for instance, there are some things that you can do on monitoring and revising risk management programs. Let's say I can give an example for wheat or winter crop. Let's say you planted your wheat this season, maybe on the 1st of April, or some they plant as early as maybe end of March. But during the course of the season, you find out that that crop is going to be struck hard by frost. Then next year, you realize that, you know what? Last year I planted my crop very early, and right at the critical stage of flowering, it coincides with frost. Then what can I do to try and minimize that kind of loss? Because yes, in as far as insurance is concerned, we can compensate you the loss, but it might not be to the full potential that you are going to get when you look through your crop up to the marketing, when you send your crop to the market. So you then consider, say, okay, last year I planted early and it has coincided with the frost. Then next season, when we are now revising your risk management techniques, you say, okay, instead of me getting in very early, let me try to come in a little bit later. Let's say maybe on the 1st of May. So that when the frost hits, depending on your area, you know that my area is very prone to frost, severe frost, maybe around June or July, end of July, thereabout. So you try then to plant so that when the crop reaches that critical stage, it will not then coincide with the severe frost. So these are some of the things that as a farmer can do, or that we advise the farmer to do. So there are so many of them. So this risk management offering, it varies from one risk to another. It varies from one crop to another. If it is livestock as well, it varies. So, but otherwise, this is just a framework where you need to identify, analyze the exposure, examine the feasibility of that, select the appropriate technique, then you implement the technique. Then as you go on, you evaluate, you monitor, and so on. Then the importance of smallholder. As I have said, but this risk management process that I was explaining, it applies across whether smallholder or large-scale farmer, it applies. So why are we focused today on smallholder farmers? What are the importance of smallholder farmers? The smallholders, I think, that produce food for the whole in agriculture. And most of this 70% is smallholder farmers. So they contribute significantly to national food production in livelihoods. But however, in their endeavor to produce for the nation, for themselves, and for the nation in its large, there are some challenges that they face. And these challenges involves or encompass climate-related risks, which include the drought, the floods, the cyclones, heat waves, etc. And they also face challenges like pests and diseases. And ultimately, they will affect their productivity or their production, and as a result, the food security for the nation. They have also limited access to finance and technology, and they also have some price fluctuations. So there are quite an array of the challenges that the smallholder farmers will face. But today we are trying to focus on those challenges that can be solved or that can be mitigated, that can be reduced or minimized by insurance. But how then does insurance enhance food security for a smallholder farmer? Like I said, they are significant producers of food for the nation. But however, they are faced with those challenges that I've said. So insurance will come as a mitigatory measure. So on risk mitigation, if farmers take out insurance, they will be mitigating the unexpected losses, or they will be covering themselves against unexpected losses that are due to climate-related events like the drought, cyclones, flooding, lightning, etc. Diseases. So if they can mitigate these kind of losses, they will ensure that they will produce food, and the production also is stabilized if they can mitigate such kind of losses. Then also, how does insurance enhance food security? It does through encouraging investments in agriculture. How does insurance encourage investment in agriculture? We are saying with insurance, farmers can invest in better seeds, because, like I said, as part of risk management, we'll be encouraging them to do or to observe proper crop husbandry. And proper crop husbandry starts by choosing the right seed. And we'll be recommending them to buy hybrid seeds from reputable companies. So by so doing, they know that, yes, I need to go and fetch a rightful seed from a reliable seed house, because I know if anything happens anyway, I'm covering all the costs that I'm going to incur. So in that way, it encourages investment. And it also encourages them to even invest in buying more equipment, and also practicing proper practices. Like, let's say we encourage them to conduct soil analysis. In soil analysis, you know that you apply the type of fertilizers, the recommended, or the what is required by the crop. You just don't apply unknowingly. So by conducting these kind of practices, they encourage them to do proper crop production. Then they also have access to credit. How then does they have access? By having insurance. How? So we are saying by having or by taking out insurance, you can use that insurance as collateral. There are some banks that requires insurance as collateral. So if you take out insurance, use it as collateral to go and get more finances to finance your operations, and also to finance your inputs. Then it also increases the financial security. With secured income from insurance, farmers are more likely to take out loans for agricultural development. I think it's more or less the same like that one, to say it gives them security, that the farmer will have confidence to approach any bank to say, I'm doing this operation, here are my cash flows, etc. Here is my production history, and they'll be able to take out loans to actually expand their business. Then income stability for the farmers themselves, because they produce so that they can get income after selling the produce. So let's say the crop has been wiped out by hailstorm or by drought, at least he is going to be compensated something. And you're going to get some income to, if he fails to produce for his family, then he can be able to use that income to go and find food, and also to go and pay for the loans that they would have taken from various financiers. Then it also improves livelihoods and it reduces poverty. Like in broader terms, it improves. So it's actually a safe net for the farmers to have insurance. Still, on some of the ways how the insurance enhances food security, it encourages better risk management. I think I've alluded to them before, to say things like your soil conservation methods, your water management, your soil analysis, etc. These kind of practices, they improve productivity and sustainability of the whole production cycle of the crop. Then support for post-crisis recovery. Again, after a loss has happened, a disaster is occurred, at least they can recover something from insurance. And by so doing, they can be able to go back. Let's say if a disaster happens while they're still during the early stages of the season, the farmer can decide to replant, or if it is later in the season, at least or if it is livestock, they can restock. So these are how they can have support after post-crisis recovery. Then building resilience. With the financial buffer provided by insurance, smallholder farmers are better equipped to deal with shocks and stresses that would otherwise undermine their ability to produce. So I think they speak to the same thing, to say at least after a disaster is occurred, they have got something to fall back on, and say that they prepare themselves against these shocks and distresses that are associated with farming as a whole. Then there are several types of agricultural insurance that these farmers can decide to take. They are quite broad. These are broader types that you have listed here. There is the indemnity insurance. By indemnity insurance, we are simply saying, or this kind of insurance, it places the farmer on the same position that he or she was immediately just before the loss. So we're saying, before the loss, I've done my 1 hectare of tobacco, and maybe my cost of production was 5,000. And after adding some other things and so forth, maybe all the total cost that I would have incurred, maybe it's around 10,000 thereabout. So what then happens when a loss occurs? Let's say a hailstorm, windstorm has occurred. The insurance would then compensate what the farmer would have used, or the cost that the farmer would have accrued up to that stage when the loss has happened. That is if the cover is based on production cost, or if it is based on yield. It means it involves then the cost that the farmer would have incurred and the anticipated margin, anticipated profit. So it just places you back to where you were before, just a loss is occurred. So there's so this indemnity insurance, they are both on livestock or on crop. Then the parametric insurance. These are index-based insurance. And we strongly, or we normally recommend these parametric insurance products to the small-scale farmers by virtue of their spread and the nature of their risk. They can be grouped easily and so forth. So this, it compensates or it covers the probability or the likelihood of a loss causing event happening instead of the actual loss that would have happened. So we are saying we are covering drought. How do we cover drought in relation to maize? The cover is the product is structured in such a way that, okay, if we are covering drought, we are covering the amount of rainfall that the crop requires for its full cycle. So you can categorize this to say, okay, we have germination phase, we have vegetative phase, we have flowering stage, or you can categorize like that. Then you say, okay, at germination, how many millimeters of rainfall does maize crop require? Then at vegetative, how many millimeters of rainfall does it require? At flowering and so forth and so on. Then for the full season, how many millimeters of rainfall does the crop require of maize? So we are saying how this works now. We then come up with parameters to say, okay, if at germination, if the farmer manages to receive, say, 25 millimeters or 30 millimeters, we say he has received enough rainfall for the crop to germinate. Then at vegetative to flowering, he's supposed to receive maybe, let's say 300 millimeters, but it should be staggered in such a way that you have enough rainfall across the whole period. So it involves quite a lot of things, how we are supposed to come up with this product. But what we simply say is we say, okay, at the end of the season, or during the course of the season, if then I fail to receive, say, 500 millimeters that I was expecting, it means I have the index is triggered. So it means I'm now supposed to receive a payout. So we are saying if you predefine the thresholds, that is say, okay, the thresholds that we are dealing with is A, B, C, D. So if these thresholds are met, it means I'm going to compensate this 10%, 30%, 50%, and so forth and so on. I think this we are going to deal more in detail on the second presentation. Then the revenue protection. This one is another type or another class of insurance, but locally we don't have this. It's common in stable in economies, the United States and so forth, but it just guarantees a certain level of revenue rather than just production. To say those price fluctuations, if say I have insured at $500, but during the course of this the season the price drops, then you can insure that kind of fluctuations. Then I think we are going to, the second presentation is going to focus on the products that are actually or that have been given to farmers as we speak right now, and they've been given those kind of products for quite a long time. So this is just these are just the statistics for Minerva. I think we have been given weather index products since the 2016-2017 season, and it was just a small group of farmers. The first year we had a group in Chiweshe, another group in Goromonzi, Juru area there, and Chinoi. And those are the number of farmers that we insured in the hectares, and those were the premiums that they paid, the claims amount, the loss ratio. I think the trend you can see there is just this product. It's for every dollar that the farmer would have paid, will pay back $1.68. So in as far as the insurance is concerned, it's a loss-making product, but at least it's better for the farmers because they've got somewhere to fall back on. So this is just the experience that we had for over the years. This current season, we have a small group of farmers again in Chiweshe, but this time around they don't have weather index product. We are actually, this is our first year to pilot what we call area yield index. It's part of parametric insurance. So the parametric insurance, it involves the weather index, it involves soil moisture index, it involves area yield index, and even in livestock there's also a product, parametric products that covers or that focuses on vegetation index. So this is just the statistics. Then what is covered in crop insurance? I think there are broader ways how you can cover or you can take up cover. It's either it's input based or it's yield based. As the terms themselves are, I think it's clear to say on input based, we are simply saying, I just want to ensure what I have put in to grow the crop. That is the amount of inputs. Then on the yield, you are now looking at the potential that you expect to get. And I think in as far as this is just for these are just forecast that you recently shared. These are the targets that as you are aware that we are now into winter period. So those are the targeted acreages that various players or stakeholders expecting. Then what is covered on the winter crop? Those are the things that we have covered, whether barley or wheat. We cover things like frost, your pre-germination, windstorm, and transit risks. These are some of the risks that are covered. So what happens on crop insurance? What is covered varies with the type of the crop or with the season. Let's say the summer crop and the winter crop. During winter crop, I think the major risk there will be frost. But during the summer season, the major risks includes your drought, your hailstorm, and windstorm. So it relatively varies with the season. And this is simply information that is required for one to underwrite or to give a quotation for a farmer. Then this just a service team. I think this is just an introductory part, but I think the gist of the matter is going to be in the second presenter, which is our partner AFC.
Great, thank you, Sandra.
Thank you.
We normally have question and answer after a presentation, but I think let's get Catherine up first, and then we can address all the questions sort of after time is spoken. Yeah.
That's great.
So it's we're privileged to have Catherine here today. Right. So he's a seasoned insurance executive with 20 years of experience holding various academic and professional qualifications. He's passionate about developing innovative risk solutions that help mitigate risk, especially for the marginalized and financially excluded communities. Currently, he serves as the managing director of AFC Insurance, a subsidiary of AFC Holdings, where he focuses on agricultural insurance and other short-term insurance products. So it's a warm welcome, Catherine. Thank you very much. Thank you very much for joining us.
So good afternoon, colleagues, and thank you so much for the invitation and for allowing me to speak to you this afternoon. And many thanks to Sandra for warming the stage. I think she's done almost half the work that I was supposed to do. In fact, 95% of the work that I was supposed to do. So funny story, I sent my presentation to Michael sometime in the afternoon today, and he looked at it and he said, wow, this is like for 45 minutes or for 2 hours. You only have 20 minutes. So thanks, Sandra, for ensuring that I'll stick to the 20 minutes that I've been allocated. So thank you for that introduction as well. I'm working for AFC at the moment, but I really have a passion for the development of smallholder farmers. In my previous life, I lived in a very small island, beautiful island of Mauritius, where there was quite a lot of transformation from people who used to be small-scale sugarcane farmers who now own huge estates, factories, and stuff like that. And that's the sort of development that I aspire to see one day in Zimbabwe, where we take the smallholder farmer from where they are to where they're surplus oriented and where they're able to sustain their livelihood based on the production from their farm. We'll just keep that overview. I think this is a presentation that I've really recycled. There's some disclosure that I'm making there. But a little bit about ourselves as well. So we are a short-term insurance company, largely owned by the AFC group, and our mandate is to support the development of agriculture in Zimbabwe, and we do this through the provision of insurance. We can move to the next slide. That just gives you a bit of the structure of the group, where we have the commercial bank, we have AFC leasing company, we have AFC land and development bank, which is a development finance institution, and it's again working with farmers to advance their cause. Then, I'll then just move straight into the crux of my presentation, and maybe just to bring close some of the concepts that Sandra spoke to earlier on. And one of the things that Sandra kept talking about is the concept of risk. And this is important because the thing about insurance, or what we're talking about insurance, is all about risk management and how we react to risk. So for me, risk is prevalent in everything that we do. The moment you get into your car driving to work, you're exposed to risk. The moment you drink water, you're exposed to risk. You can choke and die, right? So risk is like part of everything that we do. And in agriculture, it's more important because of those fundamental benefits that we get out of agriculture. When you start the enterprise of agriculture, you want to have some sort of output from there. You've invested your money. Maybe you are a financier and you put money in there. So you're expecting some outcome. And what we're concerned about is what happens if there's a diversion or a divergence from that outcome that you desired and the actual outcome. And some of the things that actually cause these outcomes to be different is what we call a peril. And again, Sandra spoke to this word that we call a peril. And for me, a peril is any event or situation or incident that causes damage. So it can be hail, it can be a fire, it can be anything that really results in a loss. And for those who like football, that guy used to be a defender. I think he's still a defender. And his name is not Hazard, but some actually say he's a hazard. But that one there is actually Hazard there. So I'll tell you what a hazard is. So a hazard is a condition that increases the probability of loss. So we've defined a peril, and we say it is an incident or a thing that leads to a loss. A theft, for example, breaking and theft. That's the peril. But the hazard could be the absence of a security guard that increases the chance of the loss actually happening. The absence of a fire guard that actually increases the chance of a fire actually happening. Or planting outside the planting window that actually increases the chance of your yield not being what you wanted it to be. So I just thought I would define some of those terms as well, just to bring them closer to home, because we're going to use these terms quite a lot. But as we move into agriculture, we all know that there are risks that are associated with agriculture. And some of the risks that we are really concerned about are risks that we call production risk and risks that really affect productivity. Again, my co-presenter mentioned some of these things. These include pests and disease, and we are all familiar with some of these production risks that are associated with agriculture. This year, we had quite a lot of incidents of fall armyworm, African armyworm as well. All these act collectively to reduce the outcome that we would have desired, and that is the risk. And we're going to talk about how insurance actually mitigates against some of these risks. So whenever you are faced with risk, there are quite, I would say, about 5 alternatives or options or course of action that one has. One is risk avoidance. You simply don't go to the farm. You sit in your house and you relax and nothing happens to you. You don't get in your car, sit in your car, lie in bed, nothing happens to you. No risk. And that's risk avoidance. You completely avoid it. But we'd all agree that we don't want to avoid risk. And risk is the spice of life anyway. You know, the riskier, the better. The higher the risk, the higher the returns. So the first option is risk avoidance. And we've simply disqualified that and said we still want to practice the enterprise of agriculture. So we won't avoid agriculture. We're going to do it. The second one is risk reduction. You reduce the risk doing different types of crops, planting at different days and all that. But we'd all understand that even as much as I can reduce it, I won't be able to eliminate it. Sandra spoke earlier about risk management. So risk management is really trying to reduce the risk. You can then irrigate. So if the risk is drought, you have your irrigation and you are reducing the impacts of drought on your crop. So for hail, unfortunately, we can't put hail nets because we can't do that. But we can try to grow crops that are less susceptible to damage by hail. We can spread the risk as well. Instead of having one farm in one place, you have multiple farms in different places, and again, spreading the risk. you can again accept the risk. You just know that, well, there's going to be hail and I'm going to lose 50% of my field, and I'm going to make my projections given that this is what I'm living with. I know there's going to be pilferage, there's going to be this. So there's some risks that we can actually afford to live with, but to a certain magnitude. But the final option that is always available to the farmer is the risk transfer. So when we have done all these things and try to manage the risk in ways that we can, that insurance is concerned with that residual risk that we can't do anything about. And how we manage this is by transferring it to an insurance company. And I'll just break down the concept of insurance to you and say it is really the pooling of funds where you take multiple exposures, so multiple farmers with different and varied exposures, and putting them in one basket, then paying a payout from that basket. What this achieves is the fortunes of the unfortunate pay, of the fortunate pay the unfortunate. So I'll give an example of a house. If one house is to burn down here in Borodale, you're probably paying 200,000. But if you have 100,000 people contributing to build that individual house, we are probably paying a very small amount of money, perhaps $100 per household that is contributing to this. So that's simply the mechanism of insurance, where a lot of exposure units come together, collect and build a fund where claims are actually paid from. So the fund has to be huge enough. And the concept of insurance is not new, as most of us would appreciate. Started years and years back, and we are still on that journey in Zimbabwe, trying to grow the uptake and use of insurance. So that slide just shows the premiums that come out of different markets and where Zimbabwe sits. And we, compared to other countries, we're still far in terms of insurance uptake. I think of all the crops that are currently grown in Zimbabwe, less than 10% actually go with insurance. Insurance covers a lot of variables or a lot of crops. You have your field crops, your livestock, as Sandra mentioned. You also have specialist classes like aquaculture, your fisheries, flowers, horticulture, game, and all those sophisticated types of products. So there are insurance solutions that are available to that. There are different models and variations of how insurance can actually be provided. Sandra spoke about parametric insurance, or the different forms of parametric. And I'll start by talking about indemnity, which Sandra again spoke about. And I'll delve deeper into the indemnity form of insurance. But I'll also touch briefly on parametric insurance, where we basically have two broad types of parametric insurance practiced in Zimbabwe. The first one is your weather index insurance. And weather index insurance simply looks at weather elements, and you are insuring weather conditions. That divergence that I spoke about, that risks, those risks that can come out of the weather not behaving in a way that you want. And obviously, when you look at weather, you are basically looking at your smallholder farmers largely, because they are the ones that largely depend on weather. They don't have access to irrigation in most cases. They don't have access to greenhouses in most cases. So this would be something that would be of interest to smallholder farmers. Area yield index insurance is again another parametric form of insurance. And by parametric, we simply mean you have a matrix that you are measuring. It's an index, and you're simply saying, should there be a divergence from the ideal conditions, and then there is a loss, and you compensate for that. There's obviously satellite-based insurance, and this is largely what we see with what is called the normalized digital vegetation index. This is your NDVI, differential vegetation index, sorry. And it's largely used in livestock insurance, where you are insuring the level of pasture and you are measuring the level of pasture in an environment. So if a unit of livestock probably requires, let's say, 5 kgs of grass to feed in a season, and should the level of pasture in a square kilometer go below that, then it triggers a payout, and that payout goes to buying supplementary feeding for the livestock. We're not going to talk about that, but that is a product that is available, and it largely relies on satellite data. I'll speak on parametric insurance largely, and indemnity insurance to some extent. I'll just skip this slide and go into this slide, which really speaks more to indemnity or named perils insurance. As Sandra alluded, is simply trying to put the farmer back to the position that they occupied before the loss. And one form of indemnity insurance that we'll all be familiar with is the tobacco hail insurance. what this tobacco insurance does is it's got a named peril. There is a standard peril that we are actually, myself and the farmer are agreeing to say, I want to be insured for this. This is where we call it a named perils, because we are saying fire is the problem that I want to insure here. So I have fire there. Hail is the problem that I have hail there. Frost is what I have as a problem, and I have it there. So you agree with the farmer in terms of what you want to offer. So one simple example of that is your tobacco hail insurance. So it will respond if there is hail on the field. So if there is a theft of the tobacco houses on the field, we are not worried. If there's a drought, the insurers are not bothered because it's not named in the contract. But we've also seen some contracts nowadays where cover has actually been extended to include drought and excessive rainfall on tobacco. But look, these are new developments which we are also quite interested in exploring. But the unique characteristic, again, of indemnity insurance is that it's based on an assessment, on an individual claim assessment. So if there's hail activity on a farm, an assessor goes onto the farm, tries to establish what percentage of leaves were damaged, and matches that against the output that the farmer was going to get, and a compensation is agreed upon with the insured. So it's basically trying to put them back to the position that they occupied before the loss. Look at it from an example of motor. Your motor vehicle is stolen 100%, the whole car is gone. What insurance seeks to do is to give you back another car. That's indemnity. So the field is burnt by a fire. And in our first year of operation as AFC Insurance, we were quite lucky that we had a farmer in Banket, not Banket, as you're going towards Chinoi, that's Banket, yes. We had 18 hectares of wheat, and waiting for a combine harvester to come. The entire field was burnt down. We were quite lucky. It was good marketing for us because we paid the claim and the guy smiled all the way to the bank. So that's indemnity. You've got your 18 hectares gone and you have compensation coming your way. So the colleagues who were sitting behind me earlier on were whispering something to me, to each other. And they were saying, no, when insurance pays you, it's not income, it's compensation, because this is not additional income. This is really putting you back to where you were. So insurance is really not meant to profit you, but to put you back to where you were. If you were in a profit position, then you should be kept in that profit position. If you were at a break-even position, you should be kept in that break-even position. Obviously, the drawback of this model for us insurers is that we need to go into each individual farm and assess, and at times it's not practical. So this is why we would largely use it for commercial farmers and to a small extent on smallholder farmers. I'll share these notes after this presentation, but this just continues to give you a bit of information around how indemnity insurance worked, or a named perils insurance worked. But the key takeaway for me is to say it's also applicable to smallholder farmers, as we have seen it apply in tobacco insurance, and it can be used in all the other forms of insurance, as long as we have a sizable number that can make the economics make sense for the insurer to go in the field and assess the damage. I'll move on to talk of weather index, which my colleague has also spoken to earlier, and I won't really repeat what she has said, but just to say that you're picking weather elements that are measurable, and with those weather elements that are measurable, you are setting a benchmark and say, should this benchmark not be achieved, then a loss has been triggered. She referred to rainfall, for example, and you'd say in a season would expect to have, let's say, 100 mils of water for a plant to germinate. And should I receive less than that, then a payout has been triggered. I'll go on and give you an example, I think a few slides down the line, on a product that we've actually done in the past, which will show you how this sort of product actually works. And I'll also give you a practical example of an area yield index insurance product that we've done in the past. So the bottom line is we are taking the historical data of an area. It can be Mvurwi, it can be Matepa, and saying in this area, this is how the rainfall is received on a yearly basis. And should there be a diversion from there, then a payout has actually been triggered. So it covers if you have little rainfall, that is drought, deficit in rainfall, and it also covers when you have excess rainfall. And in the product that I'm going to show you, what we actually did is we divided the season, and there are portions of the season where the farmer is really worried about having more rainfall, where they require more rainfall. And there's a season like when your crop is approaching maturity, where you actually don't want the rain. Okay, and if the rain comes at that time, it's probably bad for your crops. So you get to see how we structured this product. But colleagues, the bottom line is that should the amount of rainfall exceed the historical threshold, then there is a problem. So if you have excess rainfall at the onset of the season and you can't even go to the field, you can't even apply fertilizer, you can't do anything, your plants are actually drowning in water, then that is a problem again, and it triggers a payout. So I'll move on to the next two slides and just give you an example of a product that we did. So we did this in Goromonzi as well. And this is an initiative that we did together with the Insurance Council of Zimbabwe. And it was promoted by IPEC, who is the regulator of insurance. And we called this the Farmers Basket Insurance. So with this product, what we were simply covering is we're covering the inputs. Sandra mentioned the basis of insurance, the inputs that the farmer would have put into the field. And by inputs, we're talking of the seed, we're talking of the fertilizer, we're talking of the labor that the farmer has contributed. And I think half the time we only look at the financial inputs, but not the time that has been invested in the field. So based on that, we come up with a value or a sum insured and say for every hectare that the farmer has actually grown, this is what they have invested. And the perils that we were covering, that word again, peril. We were covering the perils of drought, which is little rainfall. We're covering the peril of excessive rainfall, and we're also covering pest and disease. So normally weather index alone would not cover pest and disease because it's not a weather element. But we then called this a hybrid product because we borrowed some concepts from the area yield index insurance, where we then included pests, because we believe that it's one of the major causes of loss for farmers, especially smallholder farmers. And if you think of what the fall armyworm did. So we then divided the season into different segments. The first being the germination part of the policy, where we simply say, should the farmer fail to have germination, we should be able to quickly compensate them and allow them to go back in the field to plant again. So that's really just the germination cover. And this is largely relying on satellite data, which shows you, so you've got a planting window and the policy is triggered when that planting period starts. And should the fields of the farmers remain brown, signaling that the rains have come, the farmers have planted, but nothing has emerged from the ground, it then triggers a payout. The second phase of the season, and for this part of the season, really we're covering, I would say, lack of rainfall or drought. The second phase of the season is, as we would know, the germination, the vegetative, and the flowering season. And again, for this second phase of the season, the dominant peril that we're worried about there is the absence of rainfall. So we then measure the growth stages of the crop in decades or 10-day window periods, where if rainfall is not received within that 10-day period, it means that the crop is actually starting to struggle and wilting, and then that triggers a payout. So what is happening with all these payouts that are being triggered? It's like you're ticking a box and you're saying, okay, did I have sufficient rainfall at germination stage? No, I didn't. Then it means my farmer, probably his germination was only 80% successful. So he's got a loss there of 20%. And if I can assign a figure to it, I already have a liability to pay my farmer for that 20% which they have lost. The next stage of the crop, rainfall in maybe 5 or 10 decades was not received properly, then it means a certain level of loss was triggered there. Then the final stage of the crop, which is those two stages, is the maturity, or where it's now drying up. And basically you want more of sunshine than rainfall. But then if you receive rainfall again or excessive rainfall in that area there, then you are worried about that. And you again measure in those 10-day window periods whether you then receive rainfall in any of those. Now, largely use the satellite data, or we use satellite data, as I mentioned, and we also used on-farm monitoring, just like Sandra mentioned, going to the fields and monitoring and seeing exactly what is happening. And this normally helps, especially when you look at pests. That table there just highlights the issue of trigger that I mentioned additionally. And at the end of the season, we then make a payout to the farmer based on what would have transpired in all those stages of growth of the crop. Ideally, we would want to pay for germination cover immediately at the start of the season, so the farmer can go back to the field and do that. But practically, it's been very difficult, because normally when you then get this data and collate it and do everything, you're already maybe in December or January, where it's too late to then do that. So the compensation is all then bundled and paid out at the end of the season, and largely using mobile payment platforms to pay the farmers. So that's just additional information on how the area yield index. Oh, sorry, that's now it. That slide there really talks to you about that product that we did. The premium for this product was $15 per farmer. And we said we had a starting point of saying, let's just insure an average of 1 hectare per farmer. And the premium for that was $15. So in 2023, 2024, which is last cropping season, there was a drought, as we all know, and there was a payout of about $65 per farmer, which I think was quite good for the farmers. I'll quickly move on to speak on area yield index insurance. And the major difference between weather index and area yield index insurance is now here the proxy that we are measuring, or the index that we are measuring, is the yield. So we take the historical yield data of that farmer or of that area and say, over the past 10 years, how much have you been yielding per hectare? And if your average historical yield is maybe 1 ton per hectare, and there's the operation now of any, so we said that is the basis of insurance. But because there's excess rainfall, or there's drought, or there's pest and disease, your realized yield is now 50% of that. That's the loss that the farmer has suffered. And obviously, subject to excesses, as we would all appreciate, the farmer will then be compensated for that reduction in yield due to the operation of those agreed perils. So basically, I think 2 crucial things to talk about. 1, the historical yield, or the benchmark yield, that's our basis or our starting point. 2, the realized yield, which is the actual yield that the farmer has realized. Then number 3, the operation of those perils or risks that would have been agreed between the farmer and the insurer. So should the perils operate and the realized yield be lower than the benchmark yield, then there is compensation to a farmer. I hope at some stage we'll be able to delve more into how this actually operates. But this slide really just goes to show how this works. So you have got your expected yield, you've got your realized yield. It might not be every year that your realized yield is going to be within that threshold. So if I'm expected to have, if historically I've been having 1 ton per hectare, and this year I do 2 tons per hectare, I honestly would pocket the money as the insurer and keep the money for next year. But if your realized yield is lower than what we have agreed on, then the payout is actually triggered. So we use this model in a pilot that we did in Rushinga and Mwenezi. And we did this in 2022. And it covered quite a lot of farmers, close to 30,000 farmers that were covered in there. So one of our unique advantages is we have access to quite a huge number of farmers that we work with. So we provided insurance for these smallholder farmers, and we did the crop cut experiments, which is one difference between area yield and weather index. So with area yield index, an assessor or an agronomist actually goes on the field to look at the crops and say, what is the estimation of this yield? And I'll just explain to you how that realized yield is calculated. So during the start of the season, we do a box placement on the field. And some of you could be familiar with this. You put a box, which is normally 8 by 4 meters, and you say this is now representative of the entire field. And at the end of the season, you harvest that box, you weigh the yield from that box, and you then apply a factor based on the size of the entire field to calculate your estimated yield of that entire field. So you're not going to harvest the entire 1 hectare and say this is the output from that hectare. You're going to have a sample and estimate and get the realized yield of that. So once you have done that, you then compare this against the agreed proportion. And if there's a difference between that, then the farmer is actually compensated. So in Rushinga and Mwenezi, most of the farmers had been insured for 1 ton per hectare, but the realized yield was way, way less than that, and they were compensated for that. That's the example there that I'm just talking about, where before the season starts, you are dividing the entire country into agroecological zones, and you are taking out the historical yield for each agroecological zone. You go into the second stage, which is box placement for each household, where you're now placing a box. And once you place this box, and by the way, the farmer is not able to then say, this is where the box has been placed. I'm going to focus on this, put my fertilizer, manure, put best agronomic practice within that box. The box is really placed at a time when the farmer has already started cropping. But in the background, we already know the GPS coordinates of where the box is going to be placed. And in a basic way of explaining this to the farmers, we normally use the example of saying, in your field, you're not going to mention 1 ton per hectare and all. You're just going to say, yeah, you're going to have 10 bags of 50 kg bags as your yield. And if your yield gives you 2 bags, then there's a problem and there's a payout that is going to come to the farmer. So this is an example of how the area yield index insurance works. Another fundamental difference between area yield index and weather index is that with area yield index, it covers quite a lot of perils as compared to named perils that you have on your weather index. So the area yield is really looking at all those elements that can potentially affect your yield. So we mentioned rainfall, excess rainfall, pests, diseases, and all sorts of things. Here they are normally covered, cyclones and all those things. This type of policy normally picks that up. I'll just close by talking of a few loss experiences or loss situations that we've seen in the past, not necessarily for smallholder farmers, but largely in crop insurance. And some of these we are familiar with. One of them is 120 tons of maize destroyed by a veiled fire. And the other one, Sandra mentioned, livestock. Police discover cattle stolen from Zimbabwe, 32 livestock, crossing into Mozambique. The examples are many and we are familiar with them. But what I want to leave you with is that whatever the risk can be, as insurance practitioners, we are really committed to coming up with a solution that can mitigate those risks, especially for smallholder farmers. And I must also add and say, these insurance products that I'm talking about can also be extended to horticulture. They can be extended to your gardens. So some farmers practice horticulture in a very huge way, and these products can actually be extended to cover that as well. I'll move on to my very last slide. If you can skip 2 slides from there and just speak a little bit. I need to sell my employer as well, right? It's only fair that I do so, Michael, with your indulgence. And one thing that we propose as AFC Insurance, and obviously working with our partners, Minerva, is to provide solutions that help increase productivity, profitability, and security of all classes of farmers. How do we enhance productivity? One of them, Sandra has mentioned, we go on the field and we work with farmers as partners. We don't look at them as clients, especially smallholder farmers. We personally look at them as developing farmers and we help capacitate them. We drive them towards profitability, and I think market linkages, in my opinion, is one such initiative that helps increase that product profitability. So we also develop initiatives that reduce the financial impact of risk across the value chain. So you're not looking at just taking away money from farmers, but helping them get productive, helping them link them to markets, liaise with their regulators, and find solutions that actually help mitigate their risk. So we also want to contribute to the growth of the farming community by allowing them to go back to the field every time there's a loss. One of the reasons why smallholder farmers do not develop is when there's a loss today, they say next year I'm not going to do this because there's a loss. But if there's insurance, there's always a reason to go back to the field because there's protection and there's compensation. And lastly, we seek to collaborate with capable value chain partners for the benefit of the smallholder farmers. So thank you so much, ladies and gentlemen. My apologies. I think I've gone beyond the 10 minutes, 20 minutes, but thank you.
Heard as an insurance company how you yourself are managing the whole climate change, because obviously we're seeing a lot more dramatic events happening, the floods, the droughts, and increasing incidences of this. Does this mean that you are increasing your premiums? And what are your premiums now? Are you increasing it because you're expecting more droughts to happen? And I know this is always a real niggle, especially with smallholder farmers. If I recall, premiums used to be 9%. But how are you as a company? And when I see Minerva with 1.68 loss it's like as a business, this doesn't seem to be able to wash its face, as it were, without the support of donor funds.
So thank you. And I think that's a very interesting question. So what happens is exactly what you have described there, where the insurance market generally responds in a negative way to the occurrence of this. I'll give you one example. When we did the farmers basket in Goromonzi, we had a certain rate that was charged. And because of that huge loss that we had, premium of $15, loss paid of $65. Those who know maths can actually calculate and see where it went. This year, when we went for renewal, and by the way, we buy part of some of our capacity from international markets. So most of these international reinsurers were like, we bent in Zimbabwe, so we have to adjust our prices upward. And they did adjust that. But how we see it is as you increase the number of farmers that are insured, you're also trying to reduce the occurrence of loss. So we also then try to subsidize the losses from hormones by going beyond and having farmers from other districts come into that pool, thereby trying to reduce the premium level. But you mentioned one thing that is crucial, which is premium subsidy. And for me, that is one crucial thing that we should think about and have to come in and reduce that premium that the farmers currently pay. So what we did in Goromonzi, and again, I'll give you information on this same pilot, where the premium was now supposed to increase from $15 to $24 for Goromonzi. We tried to get some subsidy for Goromonzi farmers only, and they were able to still maintain the same premium level of $15. But for the rest of the portfolio, so now the portfolio premium had reduced to $24 or increased to $24 rather. The rest of the other participants who were joining in and coming in now had to still pay the $24. So you can imagine that difference. If we had a lot more in terms of premium subsidy, would have actually made sure that all the other farmers who are now paying $24 would have also contributed $15. So if there's access to subsidies, that would help. And in many cases or many countries that we've seen, premium subsidies effectively help increase the uptake of insurance and to significantly help reduce the protection gap. So that's my take on that. But how we are managing climate change as well is by education and awareness and training farmers on best practices. We support conservation farming as well and encouraging farmers to do minimum tillage, smallholder farmers. That is. Sandra, I don't know if you want to add to that.
Everything here, but I think the main thing that we are trying to do, like Kabete said, is to try to increase the baskets where we are pulling our resources. So the concept of law of large numbers.
Yeah.
So the more we get, the many farmers, the lesser.
Yeah, and maybe one last thing is we also, in some areas, in some programs, I mentioned Shinga in Mwenezi, where they actually grow drought-resistant varieties, your traditional grains, as they would call them. Again, they are more resilient, and we do cover those as well.
Sorry, can I just ask a follow-on question? So what is your sweet spot of number of farmers before you become viable? Are we talking a million farmers? Are we talking, because I think you mentioned that there was like in the tens of thousands. What was that one project you did, 60,000 or something?
No, in terms of the number of farmers.
Yeah.
Yeah, there were very few. I think the highest group were at 200.
Okay.
To be honest, I think the best would be to have as many farmers as possible. And this is where financial inclusion comes in, where you're trying to educate farmers on the need to take out insurance. Insurance generally is not bought, it's actually sold. I mean, people don't want to buy insurance if they have to convince them. Now you can imagine for a smallholder farmer. And we're still a long way from getting there. So the more we can invest in financial literacy training, insurance awareness training, and getting these farmers to come on board, then the better. But in terms of saying what is the ideal number, I think as much as possible. If we can at least ensure 50% of the farmers who are practicing agriculture, I think the variability would probably approach a more predictable mean. Yeah. Thank you for that question. And I suppose we've been reading about AFC Insurance, stuff and AFC Holding. So one of the main mandates that we were asked to do was to try and reduce the requirement for collateral, especially for developing farmers or the upcoming farmers. So to some extent, every loan that is given for agriculture, for example, with the Land and Development Bank, depending on the magnitude of the land, of the loan and all that, some of those loans are actually provided without collateral to a certain extent, or depending on the quantum. And there's compulsory insurance on that loan, which is basically crop insurance and to some extent drought insurance, for example. You say, so if the agronomic issues on the field fail to yield the results, we can then use that insurance policy as collateral. But I would say that is applicable to a limited extent. So if a farmer is borrowing, let's say for infrastructural development, they want to have irrigation equipment and stuff like that, I think that becomes a different conversation. But if it's really working capital that the farmer is taking for a few hectares, then the insurance policy can indeed be used for that. Which other banks are we working with? I think quite a lot of banks have now come on to financing agriculture. Sandra shared a list earlier on which had different contractors. So you have CBZ, you have NMB, you have, I think quite a lot of banks are now supporting agriculture. The Women's Bank, the Women's Bank as well is doing agriculture, Power Bank to some extent. So quite a lot of banks are doing that. I don't know if I answered everything.
Okay, thank you very much for the two very interesting presentations. So for me, it was really a comfortable building session, so I really enjoyed it. And I'll go on with something.
Thank you.
Yes, thank you very much. So from my experience, we have been working a lot with smallholder farmers.
Yeah.
And we have also engaged partners. We have tried to do the capacity building, exactly what you are saying, and to a larger extent, it has failed.
Right.
So after implementing a project for 8 years, us expecting the smallholder farmers to gradually take the full insurance on their own, because initially it was 100% subsidy from the donor. And then we had to reduce to 80%. And the number of farmers who subscribed to insurance was also reducing, until a moment in the third phase of the project where we're saying at least 25% come from the donor, and that is 75% from the farmers, and none of the farmers subscribed. And for us, it was really, that's when we realized that it's more of the context. And in our context, the Zimbabwe context, we have seen that the only insurance that works is the funeral insurance. To a smaller extent, medical works, like it gets, but funeral it works, because you know you are going to die. But for this agriculture insurance, yes, it's a private player, something that you have to market, and you have to continue capacitating our smallholder farmers so that they know that there is this insurance that can cover them. But also, if you look at your figures, and to be frank with you, if you had to calculate the figures, because I was looking at the figures that you presented on the payouts, I think there was one figure which I was interested in. I think that 23-24 season, or the last season, where there was a payout of about 16 point something, and there were about 180 farmers, and each farmer getting maybe an average of $80. What can they really do with $80? Can it bring significant change to them? That's also another question. So for me, I think when it comes to insurance for smallholder farmers, in our context, what works is exactly what she was talking about, that there is need for subsidies. As long as there are no subsidies, definitely the chances of that product working is on the low side. Then if there are subsidies, there's also the question of sustainability. To what extent would that be sustainable? If farmers cannot be 100% subscription on their own. So I just thought I would raise this. Then my question to you is for the weather-based and for the area yield index.
Yeah.
For us, with our project, with that experience, it was more of a weather-based, weather index insurance, and it did not work. But for the area-based, which we implemented with another partner with other players, with Polar, Malawi, it worked very well because it was area yield index. And exactly like how you were saying it, it worked out. And for Polar, they ended up saying that they were making a loss if they did not want to pursue with that, because for them every year they were paying the farmers, because really the yield was they were not getting the expected yield. So for the private sector, it's a loss if they go for the area yield, unlike if they use the weather based. So for the farmers that we who are your clients or your partners, do you give them an option to choose weather based or area yield, or how do you go about it? We come to subscribe to a certain insurance.
All right. Thank you. I think those are brilliant questions and contributions. Let me start by commenting on the earlier submissions around the premium level and the subsidy, and maybe I'll share some of my experience as well from other places. But I think financial literacy, especially around insurance awareness, is a long-term goal or long-term gain. It's not something that would achieve in one sitting. So last year we started an awareness campaign in 8 districts in Zimbabwe in that Farmers Basket initiative. And we managed to onboard 20,000 farmers, like subscribing, signing up for insurance. And guess how many of those farmers actually paid their premium? Less than 500 of those farmers actually paid their premium. So you can imagine the hit rate there is very small, it's very low. But I feel the insurance message is one that needs to be echoed over and over and over and over again until it becomes part of our nature. And one way of doing that is achieving it from subsidy. So you start with a position where the farmer is contributing 0 and 100% subsidized. You go to a stage where the farmer is paying 10% of that premium and 90% is coming either from government or development partners, until you get to a stage where the farmer realizes that, I need this thing called insurance. So in Zambia, they've got a program that they do where it's more like our own Funguza, where if you want to get inputs from government, you have to pay, I think it's about 400 kwacha upfront. That 400 kwacha is more like activation or registration for those inputs. It's triggering you to receive the inputs. But 50% of that is actually going to your insurance. So you're indirectly paying for your insurance without really saying you're paying for insurance. Because if you look at it, the premium that we're talking of is $24. And in as much as some households are in dire poverty and all, they should be able to contribute at least $10 or $5. I'm sure the head of the house, the father, would go to the beer hall and drink a few scans for $2, $3, but we just don't have it in ourselves to actually spend money insurance. So I believe continuous financial literacy training in the vernacular, having village champions as well, working through savings groups. In fact, it's a whole financial literacy issue where even through those savings clubs, people need to be educated on saving. So if people can be coming every week or every month and contributing $5 into that village savings pot, and then use those proceeds from that pot to pay for their insurance, then they should be. If they can pay for funeral insurance, they should be able to pay for their crops. We can have a long discussion on that. The question that you then asked was whether farmers choose whether they want to go for area yield index or for weather index. Normally, it's through the aggregator or the person who's bringing these people together for insurance. Maybe one thing I didn't mention is that ordinarily we work through an aggregator. So an aggregator can be an insurance broker like Minerva, goes to Chiweshe, identifies these 100 farmers, puts them in one bundle. Then they say we want to use area yield index. Of course, there's going to be consultation between Minerva and the farmers. They highlight the advantages, the disadvantages. They look at the exposures and they recommend an ideal program or a product for that. So normally it's the aggregator. So it could be a donor or a development funder, someone who's investing, say in Sesame, saying for these crop of farmers in Mwenezi, we want to have a weather index and they'll do that. But we also then advise on an ideal product or a product that we think is going to be responsive. As insurers, what we want at the end of the day is to pay claims. And that's why Pula became unpopular in some markets, because they would make sure that claims are paid every year and reinsurers would soon run away. But I think that would be my response. But we can continue to engage on this important subject.
I've got a question. So I've heard we had Mr. Nyajeth at the back, he stepped out, but I heard that Sable at one stage was embedding the cost of insurance in a bag of fertilizer out of the realization that farmers don't really want to pay for insurance. Has there been much of that experience in Zimbabwe? Is this something that you guys would consider?
I think that's brilliant. It's something which has worked in quite a number of markets. In Mozambique, they did a slight version of that, where they embedded the cost of insurance in the seed of maize, in the bag of maize. So within that bag of maize, we have a code that you capture on your QR code on your phone, and you subscribe to insurance, and indirectly you're buying insurance. I think it's something that would work. You are indirectly selling insurance without the farmer. One drawback, though, when we had a discussion around a very similar subject with Minister of Agriculture, was around the cost of seed, because effectively what you're doing is you're loading the cost of seed. If it's going to be $10, let's say per 10 kg bag, a bag which would have been 20 bucks is going to sell at $30 or $25. So perhaps what we need is to get the buy-in from either the fertilizer manufacturers or the seed manufacturers themselves. Then it's included in there, but it's definitely something that can be done. And thank you for that brilliant suggestion.
Thank you. And then on weather index insurance, the history of this product has been extremely rocky. I think I've heard of massive losses for the insurance companies, and some, I think Isone has at one stage invested in the masses of weather stations. I don't actually know what happened to it. And we learned from Minerva earlier on that the payout is $1.68 per dollar. So it seems to me to have one physical weather station, which is now looking at a 30 kilometer or 20 kilometer radius, and assuming that that whole area is receiving the same amount of rainfall, it seems not to be very accurate. Right. And the same on the area index. By taking a small little area in a big field, there seems to be quite a high risk that is not going to be representative of a big field. I mean, these assumptions, I don't know how much water they hold.
Okay. Thank you. So one drawback of these models that I've highlighted to you is what is called basis risk, where even with weather index, it could actually rain and you receive sufficient rainfall, but perhaps your field is on a slope, and all this rain, 50% of it is going to run off and is not going to be utilized by the crops. And that's exactly what you mentioned there. And how insurance solves this is by embedding now the physical assessment over and above the satellite observation that you are making. So in as much as you might have one rain station in a 30-kilometer radius, at the end of the season, when the seasonal yield is computed, we then validate some of these areas that actually go in there physically. And if you remember from my example, we had satellite and we also had on-field processes that go in there. With regards to the box placement and whether it's representative of the yield in the field, I think it's been proven that it actually works. And Sandra would also confirm that even in the Ministry of Agriculture, in doing their crops assessment situation in the country, they basically use a model where they perhaps are counting the number of rows and the size of crops and the yield that you're getting on a row. So it's normally cumbersome to harvest the entire field and say this is the yield from that field. But these models have actually been practiced quite a lot, and they generally are 99% accurate. But whenever there is that variation, farmers also have a right to complain or to say, no, I think the calculation for my area was not so accurate. Then it can always be supplemented by that one field experiment. It's not like we've calculated your yield is 100 kgs and that's it. I think there's and that's where collaboration comes in. That's where work with extension services also comes in, just to validate some of these results. But I would assure you that to a large extent, it's actually accurate. The other thing that you mentioned is really around the profitability. We view this as a long-term investment in farmers, because obviously, as you start, generally the farmers who are more exposed to risk are the ones that are likely going to buy insurance. And I think this is why we have these 168% loss ratios that you have. The farmer that knows my yield is going to be okay this season, there's no El Nino, everything is fine. And in fact, that's what happened to our product last year. As we started, a lot of farmers onboarded because there was talk of La Nina. But as the rain started coming around January, February, most of the farmers were looking at their fields and their crops, and they were like, hey, why should I part with my $24 when my field is looking good? So in insurance, we call that adverse selection, where farmers or consumers of insurance choose not to take out insurance when they feel they are less at risk. So I think as we go towards having a lot of farmers take out insurance, those high losses, 168% that we're seeing, will probably go down, because we have a balanced portfolio of farmers on the portfolio.
Okay. Any other questions from you? I'll start to come up with an absolutely right question. Contract farming.
Yes.
I know. I think it's probably a good vehicle for insurance companies to use, because you have an aggregator to work with, which is the company. And you can provide insurance for your weather and your pests and disease, like you said. But one of the things that occurs occasionally is strategic default, whereby the farmer side markets some of the produce, and the company ends up not making any money. Are there any products for strategic default? Is that available? I know, Sandra, you said you insure for natural things, but you don't insure for human-related things. So is that the case?
Yes.
Thank you.
Sandra deals with a lot of these contract farmers, and she'll take this bit.
Yeah, I think in this case, in situations where the farmer side markets, from the farmer side, there won't be any loss. Or maybe, I don't know, maybe your question is linked to the payment premium. That was
contractor now is
that was being referred to by Carpet. What happens is the contractor and the farmer are the ones who pay. Okay. Ordinarily, the contractors, they advance premiums on behalf of all their growers. So they will then recover those premiums when the farmer comes to sell their produce. So whether the farmer side markets, whatever portion that is going to deliver, the contractor will deduct insurance first, then they take their loan amount that they would have advanced to the farmer. So in as far as the insurers are concerned, they would have received their premiums. So normally the fight remains between the farmer and the contractor, because contractor is mainly interested in the produce. So that's where the fights are mainly.
You don't get involved in those fights.
We don't normally involved in those.
The thing is if the contractor had the confidence that it was covered for everything, including strategic default, wouldn't investment into smallholder agriculture increase?
Yeah.
Yes.
So default, I think, is one of the main concerns for contractors, and the guys in tobacco will tell you that's again a huge worry for them. The guy is contracted and he's given the seed and everything, and he chooses to sell to a makoronyera, as they would say, because I'm not going to I'm going to go to the field directly and say to this farmer, the moment your tobacco is ready, I'm paying you cash here now. You don't have to go to the auction. So there's no transport cost and stuff. And that's a huge risk for farmers. But from an insurance perspective, I wouldn't think of any solution which is there, largely because we look at it as a business risk, as a proprietary risk, which really has to be managed by other models which are not insurance. Some sort of revenue insurance in sophisticated markets where, to some extent, conditions have been put in place to prohibit side marketing, and there's still some residual. Then you can have it. But I think here we choose to leave this, as you would put it, as a fight between the contractor and the farmer. But however, there's also credit insurance that can be purchased in the event of the farmer dying for things like death and disability and stuff like that. So there's credit life available, which contractors can actually take because of their insurable interest in the farm. But where Michael runs away and sells the maize elsewhere, yeah, we still to find a solution, and we would be glad to engage and see how we can actually find a insurance solution.
Thank you very much.
Right.
I guess, sorry for dominating the conversation. Thank you very much, everybody, for joining us today. We were supposed to have our AGM, but however, we once again haven't managed to make
So even with people online, my
our problem. There's only
They have dropped.
yeah. So yeah. So thanks once again. Our next forum will be in April, and we'll be looking into food security and markets. So I think that should draw more members. Thank you. Anyway, thanks very much, everyone.